Good morning. Today with you are three gentlemen from BDO, myself included. I'm Jim San Fillippo. We also have Art Oberst and David Winkler. Today we'll be discussing sales and use tax for plumbing and mechanical contractors. This will include a discussion of real property versus personal property. When do you charge sales tax to your customers? And when do you pay sales or use tax on your materials? A large part of today's presentation will cover two relatively new and expanded exemptions. The first involves building materials for construction contracts with exempt entities, and the second exemption involves construction contracts where the value of the taxable products or services is less than 10% of the total value of the construction contract. We will first discuss the general rules for the construction contracts to set the base. Following the general rules, we'll discuss the two new and expanded exemptions and where the benefits are and where traps may be if the rules are not fully understood. So unless an exemption applies, sales tax is charged to the customer on the following: on the sale of tangible personal property, on the sale of taxable services. The taxable amount charged to the customer includes labor, materials, trip charges, fuel charges, etc. So now remember, I said sales tax is charged unless an exemption applies, which applicable exemptions may be manufacturing exemption, resale exemption, or sales to exempt entities. So when selling tangible personal property or taxable services, the material purchases that get transferred to the customer may be purchased without tax for resale by the contractor. And note, as we've got on the slide there are certain exemptions that exist with these new and expanded exemptions and some other exceptions that are out there. Then with respect to purchases of tangible personal property or taxable services from a contractor, these purchases, again, may be purchased without tax for resale. And again, note that there are certain exemptions and exceptions that exist. And then for equipment purchases, rentals, those are going to be taxable to the contractor. So then on this slide here, what we have is a number of examples. The first bullet point is the sale of materials only, such as HVAC units, ductwork, bathroom fixtures, or other property without installation. That's considered a taxable sale of personal property unless an exemption certificate is received, and then sales tax is charged on the total bill. So the next four bullet points involve services, and the rules in Wisconsin are somewhat complex as to what items are real property, what items are personal property for service work. And because we have limited time in today's session, we're not going to go through each of the examples, but the examples are to make you aware that the service of HVAC units, bathroom fixtures, and certain other items are treated as a service to personal property, even though upon installation it might be real property. So there are those distinctions that we're just trying to make you aware of before we get into these exemptions. So then next we'll discuss the general rule for construction contracts for real property construction. So when a construction contract is for real property, the sales are not taxable. That is, sales tax is not charged to the customer. In a construction contract for real property, the material purchases are taxable to the contractor unless the customer is an exempt entity that purchases those materials directly from the supplier. So we'll also get into the new exemptions and what the impact is with exempt entities. So then in a real property construction contract, with respect to purchases of real property from a subcontractor, the same thing applies. The subcontractor would pay tax on their materials, and tax is not charged by the subcontractor to the general contractor. And likewise, as we said before, any equipment purchases or rentals are taxable to the contractor. And then here we've got, some additional examples as to when you pay tax on your materials. The examples here are shown to demonstrate that the installations of HVAC units, bathrooms and non-bathroom fixtures, sanitation, plumbing systems are all real property in most situations. Therefore, sales tax is not charged to the customer, and the contractor owes tax on materials. So as before, we're not going to go through each of these examples, but the examples are really just to make you aware of what the general rules are before we get into the new exemptions. So this slide here, do you know the differences, is always a key slide that we like to emphasize a lot. If you can understand this, it will help considerably in trying to understand what's real property versus what's personal property. There's really three key points or three criteria that you should focus on when trying to determine whether a job is a real property job. The first one is whether it's physically affixed to the real estate, that is either the building or the land. Usually it's a relatively easy test to make that determination whether it's somehow affixed or attached to the real estate. The second one is whether it's intended to be permanent, and that's versus whether it's intended to be temporary. Whenever it's temporary, that's going to kick it into a personal property classification. If it's intended to be permanent, that's one more factor that leads you in the direction that it's a real property job. And then the third item, which the third item can be a more difficult determination, is whether the property serves a real estate or a building function versus some sort of process function. For example, we might have a hot water heater. So take a hot water heater in a restaurant setting, and they might have two hot water heaters. One serves the restrooms and other building functions, and they might have a dedicated hot water heater for the kitchen area and the dishwashers and the pot washers, etc., that's dedicated to the kitchen and the restaurant process. In the first example, where it's a building function, that would be considered real estate or real property, and in the second, it would be personal property because it's serving a process function of that business. So then when we're dealing with exempt entities, there's certain general rules for construction contracts with exempt entities. So first we will discuss sales of personal property and taxable services to an exempt entity. Tax is not charged to an exempt entity when it's a personal property or taxable services sold to an exempt entity, and the material purchases may be purchased without tax for resale. And remember, these are the general rules for construction contracts with exempt entities. So next, we'll discuss real property projects, which may involve either a qualifying exempt entity or a non-qualifying exempt entity. If it's a real property construction for a qualifying exempt entity, tax is not charged to the exempt entity or to the general contractor, and the materials may be non-taxable if all other criteria is met. So if we were dealing with a real property construction for a non-qualifying exempt entity, which we will explain, who that would be. If it's for a non-qualifying exempt entity, tax is not charged to that exempt entity or to the general contractor, but the contractor in this situation would pay tax on its purchases of materials. And then just a note at the bottom there, and we'll emphasize this a couple times throughout the session, is whenever required, you always want to make sure you obtain the appropriate documentation and exemption certificates. So when you're dealing with real property construction for an exempt entity that's not qualifying under that specific statute section, if an entity does not qualify for the building materials exemption, there is, and really there always has been, some planning that you can do so that the material purchases can be not taxed. So when you're planning for exempt entity to purchase materials without tax, the exempt entity can directly purchase those materials, and that would be the direct owner purchases, and the contractor can be involved with the supplier selection, assisting with preparing purchase orders, but the payment has to be by the exempt entity, and the exempt entity has to be issuing a purchase order etc. And note that a contractor cannot sell the materials to the exempt entity and then install them. So you can't have two separate invoices and say, okay, well, I'm selling the invoices and then I'm also installing them under two separate invoices. You can't do that and then claim resale in that situation. However, contractor can use two separate legal entities, but you got to be very careful here. You can have a disregarded entity, a single member LLC, where you've got one legal entity selling materials and the other installing those materials. But again, you've got to be careful. So I definitely say you have to be careful in those situations. So next up, we've got David Winkler, who's going to discuss the building materials exemption.
Thanks, Jim. So this is an exemption that will allow construction contractors to purchase their building materials tax-free for projects with certain types of tax-exempt entities. And we're going to go through at length the types of projects that qualify. Just mention at the beginning here, this is covered under section 77.54 subsection 9M of the statutes. That's where this exemption exists. There are, you could say, two phases to this exemption. It was originally enacted effective for contracts that are dated on or after January 1st, 2016, so a little more than 2 years ago. So this has been around for a little while. But it is also currently being expanded by adding the types of entities that qualify for the exemption. And those new entities will be covered for contracts dated on or after July 1st of this year. So again, there's kind of a phase 1 and phase 2 to the exemption. The last bullet point on the slide here is the overall summary of the exemption. So we'll just run through that. It is a sales and use tax exemption for building materials that are sold to a construction contractor who's performing a real property construction activity and transfers those building materials to a qualifying exempt entity, and the building materials become part of what's called a facility, that's a defined term, that is owned by the exempt entity. So there's a lot of factors there, and we'll go through those. To summarize some of the key ones here, it has to be a qualifying exempt entity. The property must become part of a facility that's in Wisconsin, owned by the entity, and the property has to be actually transferred to the exempt entity. So let's start with talking about what is a qualifying exempt entity. As I said, there's basically two phases to this. The slide you're looking at is the original list of exempt entities. So these have been exempt since the beginning of 2016. The first two bullet points basically boil down to any county or municipality in Wisconsin, so cities, villages, towns, and their school districts. Those are all qualifying entities. The third and fourth bullet points basically boil down to entities that are exempt from federal income tax under Section 501c3 of the Internal Revenue Code. And you're probably familiar with those as the type of entities that you can make a donation to and then claim a deduction on your income tax return. If the entity is a Wisconsin entity, it should already hold what's called a Wisconsin Certificate of Exempt Status, or CES, and there will be a number assigned with that. If it is not a Wisconsin entity, it probably will not have a CES number, but it should have documentation from the IRS known as a determination letter certifying that it is a 501c3 entity. The last three items on this slide are entities you're not going to come across that often, but these are also qualifying entities. There's something called a joint local water authority. There are things called county city hospitals, and then sewerage commissions and metropolitan sewerage districts. Those are all also qualifying entities. And then, as I mentioned, there's a phase 2 to the list of qualifying entities effective this July, and those are listed on slide 12. The first 3 bullet points here basically boil down to the University of Wisconsin, the Board of Regents itself, any of the 2 or 4-year campuses, or the UW extension system. So starting in July, projects for any of these entities will qualify for the exemption. The last bullet point is the Wisconsin Technical College districts. There are a number of those around the state. Example of those would be MATC in Milwaukee and WCTC in Waukesha. So those are the entities that qualify. Let's talk for a moment about the ones that don't qualify. Those are listed on this slide. One that may be a little surprising is the first one there. A state government, including the state of Wisconsin, does not qualify. Now, there is an exception. I mentioned that the UW system will qualify starting in July, but except for that, a project for a state government does not qualify. The federal government is also not a qualified entity for purposes of this exemption. The third and fourth points relate to counties and municipalities in other states. I don't think you'll run across that too often. I don't know why a city in another state would be doing a project in Wisconsin, but I suppose it could happen. The next point is that public colleges, universities, and technical colleges do not qualify. That's as of today. They will qualify, as we talked about, starting in July, but technically, as of today, they're not qualifying entities. And then, importantly, also not qualifying are Wisconsin nonprofits that are not 501c3s. So basically, entities that don't have a CES number are not qualifying. And slide 14 here gives some examples of those. So, for example, a Chamber of Commerce, that is an exempt entity. It's a tax-exempt entity. It's just not a qualifying entity. Similarly would be a volunteer fire department, because that's not actually a legal part of whatever municipality it's associated with. Professional organizations such as this one would not qualify, nor would labor unions, labor organizations. So we've covered what types of entities qualify. As I mentioned, to qualify for the exemption, you have to have a qualifying facility. And that is a defined term in the statute. The good news is it's very broadly defined. For example, any building or shelter is a qualifying facility. Also listed are parking lots or parking garages. I think a parking garage, most people would say, is a building. I don't know that they needed to list it separately, but they did, so there's no question about it. Also exempt are athletic fields and athletic parks, as well as storm sewers, water supply systems, and sewerage and wastewater treatment facilities. So it's a pretty broad list. What is not a qualifying facility? Well, the statute specifically says highways, streets, and roads. And then also anything that's not listed on the slide we just went over. And for example, a sidewalk would not fall under any of those categories, so that would not be a qualifying facility. And one of the other requirements is that the property must be transferred to the qualifying entity and become part of the facility. So for example, if you had a job where you needed to purchase some equipment to do the job that you've never needed before, and it's specifically for this project, but when the job's all over, you're going to continue to own that equipment, it doesn't become incorporated into the facility, that's not going to be a qualifying purchase. You're going to have to pay tax on that because it's not transferred to the exempt entity. So what we have at this point is a number of examples. There's 6 of them that I think will help confirm what we've gone over, maybe answer some questions you have. To break this up a little bit, Art's going to help me out here. He'll run through the facts on each one, and then I'll go over the conclusion as to taxability.
So in our first example, the contractor has a contract with Milwaukee County, and it's dated November 2017. The contract is for a building addition at the Milwaukee County Zoo. It includes HVAC and plumbing improvements, which are all considered real property functions. The building is owned by Milwaukee County.
Okay, so when we analyze this, we first look at the date. November of 17 is well after the 1/1/16 effective date of the statute, so that's fine. We then look at the type of entity, and Milwaukee County is a county, so it's a qualifying entity. We look at what's being done. It is real property construction, and the construction will become a component part of the building. And the building is a qualifying facility because buildings are listed as qualifying facilities. So all our criteria are satisfied. This is a qualifying contract, and our contractor can purchase all the materials to do this project without paying sales or use tax.
In example number 2, the contractor has a contract with the City of Milwaukee. It's dated March 2018. The contract is to construct a parking lot. The parking lot will be owned by the City of Milwaukee. So under these facts, would the purchases be exempt from tax?
They will be. This is pretty similar to the first example, except it's the city instead of the county, and they're constructing a parking lot instead of a building. But as I indicated, a parking lot is listed as a qualifying facility. So this qualifies, and all the materials that the contractor has to purchase to construct that lot can be purchased tax-free.
So I'm just going to try to throw Dave a loop here now. What happens if part of that construction activity was to install a sidewalk?
Then that portion of it would not qualify because the sidewalk is not a qualifying item. And it might be a little difficult sometimes to draw the line where the sidewalk begins and the parking lot ends. But you would have to separate those expenses.
So under example number 3, we have a county hospital. Contractor has a contract with the county hospital. It's dated January of 17. They are going to construct a cancer treatment wing to the hospital. And under this situation, the building is owned by a landlord who leases the building to the hospital.
Which is a fairly common type of financing arrangement. In this situation, we look at the date. The date is fine. It's after the effective date of the statute. We look at the entity. The entity is fine. It's a county hospital, which is part of the county, and the county is an exempt entity. The problem we have is the financing arrangement where the building is actually owned by somebody else. It's not owned by the county. It's owned by a private company. That is going to cause this contract to not qualify because the property is not being transferred to the tax-exempt entity. They're getting use of it, but not ownership of it. So this construction contractor would have to pay sales and use tax on the materials used to construct this hospital wing.
And that one could be a little tricky because let's say, you're contracting with the hospital who could be a tax-exempt entity, but you don't know that the building is owned by a third party. So in this instance, you almost have to go take another step to verify who owns the building because you might be getting paid by the hospital. They're contracting with you to do the leasehold improvements, so you think on the surface that everything's exempt, but in fact, that wouldn't be the case because the building is owned by a third party. So in example 4, we have contractor has a contract with the state of Wisconsin. It's dated July 2018. The contract is to do real property improvements for the Wisconsin DOT, HVAC, plumbing, and the building is owned by the state of Wisconsin.
So again, when we analyze this, we look at the effective date. It is July 10th of this year, which is after even the phase 2 of the statute. So there's no date question. Then we look at the entity, and that's where we have a problem on this one. It's the state of Wisconsin. Specifically, it's the Department of Transportation. And the Department of Transportation and the state is not a qualifying entity. So this project is not going to qualify, and tax will be due on the materials.
So under example 5, we have very similar fact pattern to the previous slide. The contract is with UW-Madison. Contract's dated April of 15. So they're going to do some real property improvements, fire protection and the like. And the building is owned by UW-Madison.
The problem here is you look at the date, it's April 15th of this year, which is after the original effective date of the statute, but before Phase 2. And when you look at the entity, it's UW-Madison. UW-Madison will be exempt under Phase 2, but it's not exempt as of April 15th. So this is not a qualifying project. Now, if you look at that date, April 15th, this project may not even start till after July, but that's not going to make any difference. It's not when the purchases are made or the construction occurs, it's that date of the contract. And because that's before July 1st, this project will not qualify.
So what happens if a change order is issued after the effective date of the exemption, but the original contract was signed prior to? What would happen then?
The department, in connection with the first phase of the legislation, took the position that not much of anything would change the original effective date, that the date was the key thing. Now, it's interesting, in the exemption that Jim's going to talk about later today, the legislation is different. It actually almost encourages you to change your contract date by amending it. But on this exemption, the Department of Revenue seems to be taking a pretty strict interpretation of the date.
Yeah, and the only other guidance that I've seen is if you have a revocable type contract, you can cancel the first contract and issue a new contract as of that, so that you meet the effective date. If it's an irrevocable contract, then you cannot do that. So, there may be a situation if you're kind of, as David alluded to, with the April 15th not being that far from July, you may be able to employ that in changing the contract date to meet this effective date, now that you're aware of it.
So the last example, construction contractor has a contract with MATC, doing real property building improvements. Building is owned by MATC. The conclusion would be
that it's exempt because our contract here is dated July 10th. That's after Phase 2 of the legislation, and MATC was added in this Phase 2 legislation. So, and of course, it's real property construction. It meets the other criteria. So this project will qualify for the exemption. So that's, how to qualify, or what qualifies. Let's say you do have a qualifying project. How do you claim the exemption? So as the contractor, you want to be able to purchase your materials tax-free. You'll probably be able to guess the general answer to this, because generally when you want to buy something tax-free, you supply your vendor with an exemption certificate. And that's what you're going to do in this case. You use those for when you're buying something for resale, or there's a manufacturing exemption. Same thing here. The part that's a little bit tricky is, even though that exemption certificate form is 2 pages long and has a whole long list of little boxes you can check for different exemptions, you will not find a box there for this particular exemption. So the Department of Revenue says what you should do is, there is kind of a catch-all box labeled Other Purchases Exempted by Law. You should check that box, then there's a blank next to it, and you should write in that blank, exempt under section 77.54 sub 9M Wisconsin statutes. And that will indicate to your vendor the exemption that you're claiming, and as long as you otherwise correctly and completely fill out the certificate, you should be able to buy your materials tax-free. So that is the documentation that you need to give to your vendor. More importantly, let's talk a little bit about documentation that you as the contractor want to have. You know, you may get audited by the department, 3 years from now, 4 years from now. You're going to need to have in your files everything required to prove that all these different elements of this exemption were satisfied. So one of the big things will be to be able to prove that the entity was a qualifying entity. So if it's a Wisconsin 501c3, you should have their CES number. There's not really a piece of paper you need for that, like a form, but you should have the number and their name, of course. If it's a non-Wisconsin 501c3, you'll want to have a copy of their IRS 501c3 determination letter. If it's a government, there isn't really anything you need. If your contract is with the city of Milwaukee, the state's going to understand it's with the city of Milwaukee. Really nothing specific you need for that. And then, of course, you need to keep your contract so you can prove the contract date. Of course, you keep your invoices like you would otherwise. There is a form that the state has created relating to this exemption. It's Form S-227, called Contractor Statement of Building Materials Purchased. And it can be found on the Department of Revenue website. It's not a required form. It's not a form you turn into the department. It's a form you can use to keep track of some of the key things that you're going to want to have a record of, like the organization's CES number. It's not a detailed form. It's not something where you list every purchase. So it's not the greatest thing, but you might find it useful. Maybe use it kind of as a cover form for your file for the project. And again, you can find that on the website. One last comment on documentation relates to subcontractors that have a contract qualifying under this exemption. Generally, a subcontractor needs to keep all the same type of information. So you're going to want to be able to prove who the entity was, the date of the contract, all of that. What's particularly tricky for a subcontractor is that issue of the date of the contract, because the key is the date of the contract between the general and the exempt entity, not the date of the contract between you as a subcontractor and your general contractor. And the problem is, as the subcontractor, you don't generally have a copy of the contract with the exempt entity. So the best thing to do would be to try to get a copy of that. Now, of course, the general would want to redact out, is the technical term, all the financial and other confidential information in there. But that would be okay as long as you had a copy that showed the date, the names, the signatures to show it's the actual real contract. That would be the best way to go. You also could get some sort of statement from the general where they swear that the date of the contract was such and such a date. No guarantee that that would protect you, but I'm pretty sure it would. So that takes care of the exemption regarding exempt entities. What I'm going to do at this point is turn the mic back to Jim, and he's going to talk about a new exemption that relates to selling tangible personal property when it's a relatively small part of a larger real property construction contract.
So before I jump into this other exemption, so there was definitely a lot that you covered, David and Art, with that building materials exemption. I mean, there's, as a contractor, you have to really focus on, a number of different items. One is, the effective date of these exemptions, given there's a phase 1 and a phase 2, the date of your contract that it's entered into, whether the exempt entity is a qualifying or non-qualifying entity, whether what's being constructed is a facility, and then whether the building or the item being constructed is being transferred and is owned by the exempt entity. Correct? Would that be correct in kind of summarizing? That's a lot of the different areas, in addition to the documentation that has to be maintained?
Yes, that's correct. There's a lot of pieces to it.
So what you may want to do is, you create yourself, some sort of checklist or cheat sheet so that you make sure you're dotting all your I's and crossing all the T's when dealing with, certain construction contracts.
So kind of on a high level, your decision-making process is who is the customer, and if they're a qualifying tax-exempt entity and they meet the criteria, all your materials that are being transferred are exempt from tax. If the entity that you're doing the construction for isn't a qualifying entity, then you kind of need to go back to where we started and make the determination: is it real property? Is it tangible personal property? So it doesn't matter if you're the general contractor or the subcontractor. If you're not dealing with the qualified entity, you need to make that determination so you know how to treat your materials or whether to charge sales tax to your customer.
So if you all haven't reached for the Advil bottle just yet, with all the complications of that first exemption, perhaps with this second one that deals with this 10% rule, you may be reaching for that, for something soothe your head.
Yeah, if you understand this 10% rule when we're done, shoot me an email and I'll get you a job on our tax team because it's kind of complicated.
Yes, it is. So back in October of 2013, Wisconsin added an exemption involving lump sum contracts that had minor amounts of personal property. So as of December 1st, 2017, the law got expanded to include all construction contracts. So it included lump sum contracts, time and material contracts, etc. So what we wanted to do first is we wanted to discuss the time frame between October 1st, 2013 and November 30th, 2017, and the exemption that dealt with the lump sum contract. So if you had a lump sum contract where you had taxable products and services that were less than 10% of the total contract price, then the contractor's sale of taxable products and services to its customer was not taxable. The contractor's purchases of the materials and supplies related to those taxable products and services were taxable. And note that, there is an exception when it comes to exempt entities, which I'll discuss in a bit. So if you had a lump sum contract where the taxable products and services were more than 10% of the total contract price, then this 10% rule, this exemption, didn't apply. So the contractor's sale of any taxable products and services to its customer was taxable. And then the contractor would use, amount that would have been charged, that is their normal selling price. They would have used that amount as the amount subject to sales tax, and including any markup, allocation, or management project fees that you might have in there. So you might have a project where you charge a certain amount, but then there's also a management or project fee, an additional 10%. What the department was doing is they'd go in and say, well, you got to allocate that, and 10% of that management fee got allocated to any of your taxable portion, and that was catching a lot of contractors. And then lastly, the contractors, in this situation, the contractor's purchase of materials and supplies for any taxable work would be non-taxable, because you'd basically be selling tangible personal property or taxable products or services and charging sales tax. So then what transactions are not covered by exemption? And I kind of touched upon it in the previous slide. If you've got a construction contract where the taxable products and services are more than 10% of the total contract price, then the contractor's sale of taxable products or services to its customer are taxable. So if you've got a contract where it's 10% or more, the taxable products and services, then they're not covered by this exemption. So then we talked about that shorter period between October of 2013 through November of 2017. So now we wanted to talk about the exemption as it applies to contracts that are entered into or extended, modified, renewed on December 1st, 2017 or thereafter. As stated, the new exemption now applies to all types of construction contracts, whether it be lump sum contracts, time and materials, etc. And that's to contracts where the taxable products and services are less than 10% of the total contract price. So in that situation, the contractor's sale of taxable products and services to its customer are not taxable. The contractor's purchase of materials and supplies, which would be related to any of these taxable products and services, are taxable. And again, there's an exception when it comes to exempt entities. So not only was the lump sum contract exemption expanded to include time and material contracts, the exemption was also expanded to include sales and purchases by subcontractors, and we'll explain how that works shortly. Now keep in mind, this exemption discussion is for construction contractors December 1st, 2017 thereafter. So how does it apply for the prime contractor? So for the prime contractor, you've got a construction contract where your taxable products and services are less than 10% of the total contract price. So the prime contractor's sale of taxable products and services to its customer is not taxable. But the prime contractor must pay sales or use tax on its purchase of any materials related to the taxable products and services. Again, there's an exception that deals with exempt entities. And just to continue on this slide for the prime contractor, in order to purchase taxable products and services without tax, the prime contractor must provide an exemption certificate to the subcontractor. And if you're the subcontractor, you don't apply this exemption unless you've actually received that exemption certificate. So the exemption certificates box, it'd be on page 2 at the bottom. There's an other sales exempted by law. That must be checked as the reason the purchase is exempt. And then you check that box, and within that there's a blank line there. You would write section 7754(60) Wisconsin statutes in the space provided. So if, as I said, if no exemption certificate is provided by the prime or general contractor to the subcontractor, then the subcontractor must pay tax on its sale of taxable products and services sold to the general or the prime contractor, unless the contract between the contractor and the subcontractor by itself satisfies this 10% test. So if the general contractor's contract with its customers does not meet the 10% rule, as its taxable products are greater than 10% of the contract with their customer, but the subcontractor's contract with the general does meet the test, that is, their taxable products are less than 10%, then you can apply to this exemption to the subcontractor's contract. And we'll have examples to kind of clarify this, because that's a lot there to kind of consider. So, and the last point is just that, if the contractor, the prime contractor, general contractor is doing any real property work, you still need to pay sales or use tax on its purchases of materials and supplies related to those real property improvements. So then that was how it applied to the subcontractor or prime contractor. For the subcontractor, again, as I said, the subcontractor would need to receive from the prime or general contractor, they'd want to receive that exemption certificate claiming the exemption. If you don't receive the exemption certificate from the prime or general contractor, you don't treat it as meeting this 10% rule or the 10% test. So then if you receive that exemption, or it applies if the following occurs. You receive the exemption certificate from the prime contractor, or the taxable products and services of the subcontractor's construction contract are less than 10% of the subcontractor's total contract price. So as I stated on the prior slide, even if the general or prime contractor's contract with the customer does not meet the 10% rule, as its taxable products are greater than 10% of their contractor with the customer, but the subcontractor's contract with the general does meet the test, and again, that is, their taxable products are less than 10%, then you can apply the exemption to the subcontractor's contract. And again, we'll have a specific example that we'll go through to try and make this clear. So if this exemption under the 10% rule does apply to the subcontractor's contract, here's what happened. The subcontractor's sale to the prime contractor is not taxable. The subcontractor must pay sales or use tax on its purchase of materials and supplies related to those taxable products and services. And then the subcontractor must pay sales or use tax on any of its materials related to real property improvements, similar to what we described with the general. Other times you're doing the real property improvements, you pay tax on your materials unless it meets, another exemption, as we discussed before, the building materials exemption for exempt entities. So as often is the case when it comes to sales and use tax, there's an exception to the rule, but this is a good exception, and this deals with exempt entities. So, you see the rule there that says taxable products and services sold by a contractor as part of a construction contractor with an exempt entity that are not consumed in real property construction. In other words, it's being consumed in doing personal property work. They may be purchased by the contractor without tax for resale. So the rule that a sale of taxable products or services may be purchased without tax for resale always applies to construction contracts with exempt entities. Really, the 10% rule does not have to be applied if you're dealing with exempt entity jobs. So for the exemption for the lump sum contracts entered into, this first example is really dealing with, going back to the October 1st, 2013 through November 30th, 2013 date. So you've got your facts where the contractor enters into a lump sum contract with the customer to install HVAC systems, plumbing, fire protection, and oven hoods and exhaust system in a restaurant. So the contract is for $325,000 with a breakdown as follows. So you can see you've got your various items. The one item to note is the oven hoods and exhaust system is $25,000. So since the contractor would charge $25,000 for the taxable products because the oven hoods and exhaust systems considered personal property, since they charge $25,000 for the taxable products and this amount is less than 10% of the total contract and it's a lump sum contract, then the sale of the taxable products is exempt. So the contractor owes sales or use tax on the cost of materials related to those taxable items, the oven hoods, exhaust system, and the contractor is also required to pay tax on any of its real property work. So then going into the exemption as it applies December 1st, 2017, we've got, really the same example. Contractor enters a contract with customer to install the same items. Total contract is $325,000, and you can see the oven hoods exhaust system is $25,000. And again, the oven hoods exhaust system is considered personal property. So in this situation, the $25,000 is less than 10% of the total contract. And in this situation, it doesn't matter whether you had a lump sum contract or a time and materials contract. You'd get to the same result as you did in the prior one, where it only applied to lump sum contracts. The contractor would owe sales or use tax on the cost of materials as related to the oven hoods exhaust system, and the contractor is still required to pay tax on their real property work. So in example number 3, we've got a contractor that enters into a contract with an exempt entity to install HVAC systems, plumbing, fire protection, oven hoods, and exhaust system in a restaurant. So this is, a contract that's entered into December 1st, 2017, but it's for an exempt entity. So, and it's same dollar amounts that we were looking at before for the HVAC, plumbing, fire protection, and the oven hoods and exhaust system. So in this situation, the contractor charge of $25,000 for the taxable products is exempt since the sale is to an exempt entity. The contractor in this situation may purchase the materials related to the otherwise taxable products without tax for resale, because again, we're dealing with an exempt entity anytime you've got taxable products or services with an exempt entity, you may purchase those without tax for resale. And then likewise, if you're doing any other, the real property work, the HVAC, the plumbing, the fire protection, on that real property work, the contractor would be required to pay sales and use tax on the materials. And then just note that if the contract meets that building materials exemption that David talked about for qualifying exempt entities, sales or use tax would not be due on that material. So getting into our next example, we've got, the contractor entering into exemption with a customer to install, those same items in a restaurant, the total same amount, $325,000. But here we've got the contractor subcontracting all the oven hoods, exhaust system work to the subcontractor, which charges the contractor $20,000 for this work. So the subcontractor is charging the prime contractor $20,000 for this work. The general contractor is charging their customer $25,000. So in this situation, since the contractor would charge $25,000 for the taxable products, the oven hoods exhaust system, and the construction contractor, and this amount is less than 10% of the total contract amount of $325,000, the contractor's sale of taxable products is exempt. The contractor's not required to pay tax on the $20,000 paid to the subcontractor for the oven hoods if the contractor, remember what we discussed before, if that contractor supplies the subcontractor with an exemption certificate. And then in this situation, the subcontractor would owe sales or use tax on the cost of its materials related to those taxable items, the oven hoods exhaust system.
So what would happen if the contractor didn't give the subcontractor an exemption certificate? What would the subcontractor do?
So if the subcontractor does not receive an exemption certificate from the general contractor, they would not treat it as qualifying for this exemption under the 10% rule. You would basically be considered selling personal property to the general or prime contractor, and you would charge them the subcontractor would charge tax on their $20,000 to that general contractor. And then in that situation, they'd be able to buy the materials exempt for resale because they're selling taxable products in that situation. So as a subcontractor, you definitely have to be careful because there may be projects or contracts where at times it qualifies under this 10% rule and you don't charge tax to the general contractor or your customer, and you have to pay tax on your materials. And then there's other contracts that you will not get this exemption, you will not receive an exemption certificate saying that qualifies for this 10% rule, and you might have to pay tax on your materials if it doesn't otherwise qualify, your contract doesn't otherwise qualify under the 10% rule. So it does get to be a little bit tricky.
Kind of a good rule of thumb if you are a subcontractor, if you're selling tangible personal property to a general contractor, charge them sales tax and basically force them to give you an exemption certificate, because under audit, a lot of times it's hard to go back to the general and get a certificate, even though you know that what you're doing is exempt from tax. So you're putting in process piping, at a manufacturing company, it's manufacturing, but the general contractor doesn't give you an exemption certificate and he's reselling it. In that instance, you should charge the general contractor sales tax on it. Force him, to give you the exemption certificate, because trying to get them after the fact when you're under audit can be a battle.
Yeah, and one other comment, and we don't have an example in here on this, and probably could have, is dealing with the subcontractors. Is in this, example number 4, the contractor's charge of $25,000 was less than the 10% of the contract. But you could have an example where It's actually the amount between the contractor and their customer is more than the 10%. So let's say they were charging $35,000, which would be more than the $325,000. It would not meet the 10% rule. But if the subcontractor was providing more than the oven hood's exhaust system, and if that taxable $20,000 was less than 10%, their contract would meet the 10% rule, and then you'd apply the 10% rule to that specific contract. Again, like the other exemption that we had, there can be a lot of tricky pieces and a lot of moving parts that you have to keep track of to make sure you're in good order as far as whether you qualify for this exemption. But as we said, one of the real keys is getting that exemption certificate if you're dealing with a general or a prime contractor. So those were the two exemptions that we wanted to primarily talk about today: the building materials exemption, dealing with exempt entities, and the 10% rule that got expanded from just lump sum contracts to lump sum contracts, time and material, and really all construction contracts. We did want to note that we kind of talked about the general rules at the beginning. We also wanted to note that there are other exceptions to these general rules. We're not going to go through each one of these, but just to make you aware that there are some other exceptions to the rule, common exemptions that we have listed there. A lot of times there's some special carve-outs for certain projects. You see on there listed professional sports stadiums, and right underneath there, the new Bucks facility. One other one I can think of that I don't think we have on there is the new exemption that's applying to the Foxconn development. So just to kind of make you aware that there's other exemptions. So if you got projects that would meet any of these criteria, you'd want to look at what the particular rules are and whether you meet the criteria for these as well. And then lastly, we just kind of wanted to have a slide here that if you do run into projects such as what I just discussed, where there are certain exceptions, just to kind of list what BDO does offer. We'll answer questions and address issues on sales and use tax involving tax determinations, filing requirements, exemption certificate compliance. We can assist you if you're getting audited by the Wisconsin Department of Revenue. And along with that, a lot of times we'll do a refund review of sales and use taxes, also called a reverse audit. And what we have found with a lot of contractors is there's a lot of overpayment of sales and use taxes. So a lot of times contractors can actually wind up getting a net refund from the state. Another area that we help is just coming into contractors and just looking at their processes and seeing whether they're really in good order as far as documentation and that they're keeping, and whether they're charging sales tax correctly and paying tax correctly. We also, we'll do on-site training for contractors, a number of other areas. So, we do have our contact information at the end of the presentation if you have any questions or wanted to discuss anything further. I don't know, did we have any questions that came in? It doesn't look like we had any questions come in. But we do have our contact information, emails. If you did want to follow up with any one of us, or if you can't locate that, you can always get us through contacting PMC, and they can put you in touch with us. So for that, I don't know where we're at as far as time. I think we're pretty good. So hopefully, again, as I mentioned before, you're not reaching for the Advil bottle just yet, but hopefully you've gained some knowledge here, and we thank you for your time in attending today.